If you thought buying a house was already expensive, it's gotten even worse. Despite higher interest rates and the lowest affordability in years, coupled with a 60% chance of a recession, the value of the US housing market has increased by $2 trillion, marking a 5% rise, the largest in almost a year. This has left many wondering how high prices can go, which regions are experiencing the most growth, and why Warren Buffett has exited the housing market entirely. With 2024 looking to be a crucial year for real estate, it's time to delve into what's happening and how you can navigate the situation, whether you're buying, selling, or just observing the chaos. Over the past year, the market's total value surged by $2 trillion, and over 2 years, it saw a 13.3% increase. This boom is attributed to a perfect storm of factors, including a significant shortage of homes for sale. Many homeowners are hesitant to sell because they'd lose their low mortgage rates. To give you an idea, Goldman Sachs reported that 99% of homeowners have rates below the current market offerings, with 85% under 5% and 63% between 2.5 to 4%. Additionally, in cities like Chicago, Atlanta, Los Angeles, and Washington, D.C., those with rates under 3.5% were 7.6% less likely to sell than those with rates over 3.5%. To put this in perspective, if a homeowner currently enjoys a 3% interest rate, housing prices would need to plummet by 36% for a new mortgage at today's 7% interest rate to equal the same monthly payment. This makes selling under current conditions financially unwise for many. Experts believe that a drop in the 30-year mortgage rate to around 5.5% could motivate more home buying, but we'll have to see if that happens. Home prices essentially froze at the end of 2022 due to fears of rising interest rates, leading to significant increases in value over the next year as homeowners hesitated to sell, reducing market supply. This caused prices to rise, especially in the suburbs, as remote work became more prevalent and high-cost cities lost appeal. Additionally, with the ongoing housing shortage, builders are stepping up, with new construction homes now representing a larger portion of the market inventory than in previous years, driving a surge in construction activity. Warren Buffett's recent actions in the housing market have sparked curiosity. In August 2023, he invested in 3 major US home builders, D.R. Horton, Lennar, and NVR, known for their substantial contributions to the single-family home market. At the time of purchase, these investments were worth around $800 million. Since then, these companies' stock values have significantly increased, with D.R. Horton, Lennar, and NVR seeing rises of 35%, 30%, and 20%, respectively, in just 7 months, suggesting Buffett's timing was impeccable. Warren Buffett managed to secure a $250 million profit from just one stock in 7 months, demonstrating the unique position home builders have compared to individual homeowners. Builders like D.R. Horton can use incentives to attract buyers, such as lowering mortgage rates, offering cash back, free upgrades, or discounts for quick closes. For instance, D.R. Horton has successfully offered interest rate reductions, effectively lowering rates from, say, 6.2% to 5.2%, resulting in significant savings for buyers. During the housing shortage, many turned to builders, driving up demand and profits, which, in turn, boosted their stock prices. This success prompts the question of why Buffett would exit such a lucrative investment, especially considering his philosophy of holding stocks long-term. Currently, it's unclear why Buffett decided to cash out. Some speculate that the rapid appreciation of home builder stocks may have prompted him to take profits. Others suggest he may now have a pessimistic view of the housing market. It's important to note that according to Newsweek, Buffett warned investors that Berkshire Hathaway might not continue its historic high performance, implying that expectations of significant growth are overly optimistic. Despite any concerns for the housing market, Berkshire Hathaway holds $168 billion in cash, making the home building investment a tiny fraction of its portfolio. This suggests that while Buffett's move is interesting, it might not indicate a larger issue with the housing market. Up to now, nothing has significantly driven the housing market downward. Not rising interest rates, not increasing prices, nor the economy. Instead, people are staying in their homes longer, with 40% of baby boomers having lived in their current home for over 20 years, and most plan to remain there as they age. For those who have lived in their homes for decades, the potential capital gains tax could significantly reduce their profits, prompting them to stay put. This raises the question, what would it actually take for the housing market to decline? Even a recession might not lead to increased sales, since many have secured low mortgage rates, and 40% of homeowners don't even have a mortgage. For home prices to align with historical averages, demand would need to drop by 50%, an unlikely scenario, since transaction volumes haven't dipped below 2 million since the early 80s. Alternatively, housing supply would need to double, a possibility in the future, but not immediately. Many homes have been purchased by individual investors, and as rental yields diminish relative to market prices, selling could become attractive. This also applies to Airbnb operators and speculative real estate investors. With the construction of more rental units and homeowners choosing to rent out rather than sell, market returns may decrease, but these are speculations. The market might continue to rise, as Morgan Stanley's optimistic scenario suggests. They forecast a 5% increase in housing prices, anticipating that the US economy will dodge a recession next year, leading to a revitalized housing market as incomes grow and mortgage rates slightly decrease. If mortgage rates begin to decrease, many consumers who have seen rates above 8% may eagerly take advantage of locking in rates at around 6.5 to 7%. However, this is considered their most optimistic scenario. More realistically, they anticipate a possible 3% decline in home prices by the end of 2024. In the worst-case scenario, prices could drop by up to 8% if mortgage rates stay high, the economy enters a recession, and demand for housing weakens. Yet, even in this scenario, a significant decrease in housing prices is seen as unlikely, especially since the Case-Shiller Index reported record high housing prices in December across all major markets, with even the lowest, Portland, seeing a 0.3% increase. Consequently, a 5% increase in housing prices is predicted for 2024, which is more optimistic than the 1.8% general consensus. This increase in prices, despite not being favorable for buyers, is seen as positive for the economy. This is because housing prices, as a major component of American household wealth, contribute to improving financial outlooks and boosting consumer confidence. Looking ahead, home prices are expected to rise by 2.3% in 2024, slightly below the rate of average hourly earnings, as more new homes enter the market and homeowners decide to move or downsize. As for the future of mortgage rates, they are predicted to decrease to 6% by the end of 2024 and to 5.75% by the end of 2025. Lower interest rates will make it easier for buyers to afford larger loans, potentially making housing more accessible, assuming housing prices do not continue to rise. For instance, consider that if mortgage rates dropped from 7% to 5.5%, a buyer could afford up to 177% more house. Such a decrease in rates could intensify competition in the housing market, as lower rates attract buyers who were previously priced out, leading to more bidding wars. Realtor.com has noted that every 1% decrease in mortgage rates could make 5 million additional households eligible to buy a home, likely resulting in multiple offers and less room for negotiation on inspections and appraisals. Essentially, buyers are faced with choosing between higher interest rates or more competition and higher prices, putting them in a tough position regardless of the market dynamics. This situation underscores the complexity of the housing market, which is far from returning to normal. To bridge the current 7.2 million home gap, single-family home construction would need to triple, and it would still take 4 to 5 years to catch up to demand. A viable solution seems to be increasing multifamily housing like condos and apartments, which made up 35% of housing starts in 2022, as an alternative to the pricier single-family homes. Having been in real estate since 2008, I concur that barring an unforeseen event, significant price drops are unlikely. Interest rates may not decrease swiftly, and it's uncertain how many buyers are waiting to enter the market. For those considering buying a home soon, it's crucial to shop around for the best mortgage rate. Even with rates on the rise, comparing offers can still land a better deal. Start by getting a pre-approval letter, then challenge other banks to beat that rate, and continue this process to ensure you secure the lowest possible rate. It's been discovered that buyers who compare mortgage rates can save on average $84,000 over the life of their loan. If you enjoyed, click subscribe for more financial news and analysis. Keep in mind, this video is not financial advice and is for entertainment purposes only.